First of all, I'm going to introduce Markus Arnold here, and Markus is just going to give us a kind of quick whisk through what he's seeing in the market at the moment. So let me hand over to you, Markus.
Thank you very much. Thank you for having me. Maybe a short introduction to myself. We are investment brokers that are specialized also in residential buildings all over Europe. We are based in 10 countries. My speech today is about the investment market concerning residential, and the main points will be, of course, the inflation that hit our countries, the therefore obviously necessary increasement of the interest rates, the purchase prices that will suffer from this, obviously, and also the change of the investor structure. First, the macroeconomics that are quite volatile these days, with 8% OECD inflation for the entire euro area, and even getting higher next year due to the cost of energy. I think that you all know. No news for you. The chart we all don't want to see, since we all thought that money will never cost anything anymore. Well, we were wrong about that. We did spare out the graph of the OECD, who sees the interest rate, the interest rates at 4% in 2024. Concerning the ECB, we did, of course, stay on 2% because that's what we wish for. Purchase prices of residential buildings have always been very close and very influenceable from the interest rates. I think that's all no news for us. This is the numbers that we would like to see in the future. Also, I'm very much aware that this is the last chart for the next years that we have in this size. But even in Germany, you see that the total amount of investments in residential went down quite heavily. Actually 50% down. We do think that also the yields became too low for the international investors, and this is why less transactions were done. The Nordics kept that graph quite well, but we do see that from 2017 to 2022 we had a steady increase. I think the last quarter, the last half of 2022 will be quite devastating. I will show you on the next graphs. This has a very simple reason. Residential was bought in the last years mainly by institutional investors. All these numbers that we have here is what you read in the news. It was what you get from the data mining companies. We do collect this in our market analysis department and get the grip of it. What does that mean? That we follow the big transactions. Big transactions for us is everything about 10 million euros. Knowing that in the transaction volume, this is 80%, 90% of the market. The small sizes in this graphs are not included, but they don't make that much of an amount. Well, this is what I was talking about. I mean, we had an incredible 2021, and the drop in 2022, especially in Germany, especially everywhere, is way below 2017. But at least it stays stable, when it comes to the first half of the 2022 years. One thing that doesn't show in all the graphs that we have now is institutional investors have always been broadcasting their investments. So whatever I show you here is based on public information, besides the countries where we do or we are able to track the land register, which Germany doesn't allow us. Why ever? Maybe you should think about that here, because it's quite helpful in any way. That has changed, or this information has changed a lot, and also our information that we give to you or that we can present you. Now we have a new market again. We have private investors taking over in deals where the institutional investors were not able to, due to the money costs, were not able to buy anymore. And these people don't go public. So our hope as brokers, of course, and I guess also sellers, very simple, we would like to see that the money that is lying around on bank accounts that has the need money to be changed in bricks, people that want to invest in the real asset and the only asset, and not just because I sell it, because I believe it, is real estate. They were not able to take part in this madness that has been going on in the last years. Yeah? Also, very interesting for us to see is, especially since we do a lot of cross-border deals, the international investors do look in other markets because they don't find anything in their size, in their expectation, in their own markets. Yeah? So the internationality in real estate becomes more and more a topic, something that we also like to see as brokers. Yeah? And I guess everybody in the branch, because as long as money is moving, sales keep up. We do see here the first drops in the prime yields. They are not essential. I think that in all countries where we are located, we do see that there is a slight drop, but it's not a very disturbing one. Also, we do think that the prime yields will be least affected by whatever you call the crisis these days. Same thing you see in the square meter prices. Necessity to the graphs showing before. We do see the sidestep, no more increasing of square meter prices. We have this since we're at the expo. We did try to compare with commercial topics or with so-called close to residential topics. I think also this is quite this we're quite used to. These topics, especially the senior living, will be one of the most influential in the future. We are all not getting younger and we're all having less children, so this is a necessity. And good to see that this also remains on a high level. Don't we like this one? This is the multifamily investment market that we think is 3 to 4 times higher than what we see. Being very quiet about the transactions and also the sellers who needed to sell for a lower price, not going public. But this is actually what you see public, so you can see that there is a little change or a big change in the market. Otherwise, the publicity of the deals that are residential would be in a very different level from what we see here. Prime yields going up a little, again, not essential. From 2.6 to 2.7. 2.5 to 2.7, this is not something that we should be worried about, and we really do believe in the prime location, so nothing will change. Enough money on the markets that needs to be invested in real estate. We picked out the Nordic investment market since it is a quite interesting figure from what we see from all over Europe. Still rising, also having had an incredible 2021, but quite well keeping up these days. The prime yields below 3% and also making a sidestep, not decreasing, and as everywhere else, not increasing. Multifamily home have been the biggest part of investment, and this will keep on rising, since there you had institutional investors buying for billions, and now the private market, the private funds, the family offices, the high net worth individuals are joining this train and buying. Picked out Spain, also an interesting chart. 2017 to 2019 is not very representative. You had a lot of institutional investors like insurance companies, banks selling their portfolios. This is why the numbers have been quite high in the multifamily residentials. And the prime yields also very slightly rising. I think Spain has never recovered really from 2009 with very heavy criteria for loans. That's why you have a very stable market. Prime yields as everywhere around 3% in the capital, also in Spain. I would have wanted to give you better news in the beginning of the expo, but again, the broker is always only forwarding the message, not making it. Thank you very much for your attention.
Thanks very much. Let's just start with introductions if we can. So maybe let's start with you at that end, Jake. Normally I would say please take 2 minutes to introduce yourself, but we're short on time. It's very focused here for the audience, so I'm going to say 30 seconds each. Jake, go.
Hello, good morning everybody. My name is Jephcott and I am here today representing Tonsa. Tonsa is a family office based in Luxembourg, and the company which you'll see I think on the screen there is Vivia. And Vivia is a spin-off of a very large construction company that we also own. This is delivering modular construction for European markets in the asset classes of residential, senior living, student living, basically everything that is now required for the residential markets. And we can actually deliver this with high technology modular construction solutions, which are much faster than traditional methods. That's it.
Good morning, everybody. My name is Christian Fladeland. I'm the Chief Investment Officer at Heimstaden. Heimstaden is a residential owner and operator. Even though our name sounds a bit German, we are actually a Scandinavian company, originates out of Norway originally, and we entered the pan-European market in 2018 by going into the Netherlands and Germany. Today we are present across 10 markets and have 155,000 residential units under management.
Good morning, my name is Agata Jurek-Zbrojska. I'm from CMS law firm. We are present in whole Europe, very strong in Germany, but also in other jurisdictions, and with huge presence in CE. I'm from Warsaw, Poland.
Good morning from my side as well. I'm Nonnengässer, representing International Campus Group here. We are a investor, developer, operator of student housing and young professional living. We focus on Germany, Austria, the Netherlands, and our current universe is around 8,000 units. And we are further developing into other European countries, especially into the Nordics in due course.
Good morning, everyone. I'm Mark Kuijpers from Greystar. Greystar is a vertically integrated investment firm, development firm, as well as operational platform. So we typically invest in student housing, which we develop ourselves, young professional / urban living, as well as multifamily. We do that across multiple European markets, and actually I'm overseeing the Dutch, German, and Austrian market, like my colleague next to me.
Deliverer of bad messages, Markus Arnold, broker, neighbor and broker. And
let's just start with you, Mark, if we can. Obviously, huge changes since Expo Real 2021. So I suppose, how would you characterize the market? What are you seeing at the moment? I suppose, huge changes over the last 6 months, Mark.
Yeah, absolutely. I think it was really well summarized in the sheet that was not really covered by you, but I think there was a couple of points on there that really tell the story. So what we see is there, let's say, the underlying fundamentals in terms of demand from resident remain strong, and they will remain strong in the near future as well. We see strong urbanization, household formation, so smaller households, and we see especially a huge demand from target groups like students, young professionals, as well as seniors. On the flip side, obviously, we also see interest rates increasing, cap rates expanding. So yeah, we need to see where that will play out. The good thing, I think, looking at it from a Greystar perspective, is that we're typically a value-add player in terms that we do our own development, we do our own operations, which allows us to, even in those sort of volatile markets, to still find opportunities where we can drive value, which essentially also protects you against cap rate expansions, because you have more cushion in your investment thesis.
That's interesting. Thank you for that, Mark. Rainer, just coming to you. I guess, how do you see residential? Residential logistics have been high on investors, views for the last couple of years. Given the current market, I suppose, how do you see residential in comparison to other asset classes?
Well, I think in addition to what Mark already said, I still strongly believe that the attractiveness of the residential investment will remain strong over time. We need to clearly differentiate between the investment side and development side of things, and then the ownership side, where you have currently the situation that if all those who own stock see rents rising because pressure from the demand side is facing a flat offer. For owners, the challenge will be to manage with increasing energy costs going forward to make sure that the bottom line is not negatively affected. On the investment and development side, especially in Germany, we have had a very strong dip since the energy efficiency programs of KfW for new construction have been abandoned earlier this year. No new programs have been introduced so far. So there is a gap currently, which is pretty obvious in the number of developments that have been stopped in the first half. And here also we need to see what the interest curve, what the construction cost curve will look like in the next months. So we expect that we will see a new normality from first quarter next year on, taking ground and things reviving again. But in the meantime, I think, especially on the development and investment side, we will see a certain pausing effect. But compared to other asset classes, as said, I think residential will be and remain one of the top spots for investments on the institutional landscape going forward.
Okay, good. Agata, I'd like to come to you. Obviously, I mean, the useful thing is that we've got a really interesting spread of geographies and different experience on the panel. And obviously, you're based there in Poland, Agata. So what's the situation, I suppose? Feel free to pick up any of the points that we've seen so far. But how are you seeing this, I guess, in Poland, but also wider CEE?
Yes, exactly. Well, I think it's important to mention a bit of difference on the current situation on CE market in the residential sector. This was visible on your presentation, Markus, that obviously we have challenges like the inflation increase and increase of interest rates. But on the other hand, which is really important to mention, that the prediction of economic growth in CE countries, in Poland, in Czech Republic, is still the growth, yes, which is really important, which is around 3%, as you presented in the presentation. And we are at this stage in CE countries where we see the movement from the ownership preferences and affordability of housing to going to the residential rental market. And this will not stop exactly because of these economic indicators. And this already started, which was also visible on the statistics in 2019, 2020, and this will move further. And therefore, I think that this region is importantly to be observed, and we think that the international money, international investors already noticed that and noticed the opportunities there as well. So that's, I think, the first point. And talking about the stock and the current investments which are in the residential PRS sector, it's important to notice that the most of the building, or all of the buildings in most cases, are the new one, which means that they are developed according to the current new standard, which cause less concerns about taking care of environmental issues, concern energy savings and so on. So that's maybe these 2 points to really pick up thinking about the investments in CE.
Great, thanks. And Christian, just coming to you, obviously, big focus there on the Nordics. I guess just give us a quick introduction to that market and a little bit in terms of what you're seeing as the key trends and drivers, and feel free to pick up any of the other points.
I believe the Nordic residential drivers is very similar to the general one that Mark described. We see a significant supply-demand imbalance, very strong urbanization, and a supply that has been lagging on a steady basis. So the fundamentals in the Nordics is just as intact now as they was 12 months ago. What has of course happened is that the cost of living and the affordability has really gained momentum in the past 3 months. So even though the demand is non-cyclical, you really need to be comfortable that you will not see a pressure on your tenants' affordability, resulting in vacancy risk, bad debt, etc. So I think one needs to be very humble about the macroeconomic environment that we're in today. It's not an environment that many asset classes really like, but we definitely see that residential is probably where you would get the most resilient returns. We also saw from Markus's chart, there is a lot of the trends from the increasing interest rates impact on the ownership housing market that is impacting a lot on the rental side. So we actually see historical strong operation, not only in the Nordics, but across all our markets, very strong rental growth. But what one needs to be focused on today is that the supply-demand imbalance is not enough to maintain a strong NOI. You also need to have affordable price points that your tenants can actually afford.
Okay, good. And that affordability, I think, is really interesting. And Jake, maybe coming to you. I mean, there's a lot of focus on ESG, affordable housing, whether or not that's affordability in terms of the social side where it's capped rents or whether it's just making more affordable housing. You're obviously coming at it from the construction point of view. So what are the things that can be done now, both in terms of, I guess, making build costs lower and being able to kind of support the more affordable side, housing side, and also anything I suppose you've got in terms of what's expected in the market now from you as a builder?
Sure. I mean, it's those three famous letters. I mean, it's ESG, and we see that investors are now obviously taking ESG into their agendas a lot more seriously. I mean, I think it's been on the radar for a suitably long time now, and it's just become normal. So a lot of the requests that we get for our technology now, we've had to kind of do as much as we can to really get into that program. We've developed new factories which are zero waste. We've employed a lot more of a spread of workforce in terms of age group. We've got a lot more automation which is involved, and then now sort of moving towards the modular. We are really championing the modular technology. Because of its ESG components, whether it's the on-site pollution, or it's the noise, or it's the labour force, it's the transport, all of those things now we see a lot more demand for. So we're having to cater the technology much more in this kind of style. And I think that now, with the market being as it is, it's kind of like a two-edged sword. On half of the side, on half of this, we have a slowdown in investors approaching us for new projects. This is one. But then we've also got a lot of investors which are coming back and saying, well, I was going to deliver this in a traditional style. This is a project that was going to take traditionally 2 years to complete. Now, I don't know where the market's going to be in 2 years. I don't know if I'm going to have the labour force which is going to be able to deliver this on site. I'm not sure about the ESG anymore because this project was designed 12 months ago. Can you then alter this now in your technology? Can you redesign this in your technology to then, give it more transparency, more control, or whatever in both ESG but also in investment costs? But then also they coming and saying, well, we can actually pay a little bit more of a premium. We can pay that 2% or 3% from our initial projected margin because we actually really need to deliver something. And that's kind of like where the advantage for us today comes in, is that we have a lot of this uncertainty, which is good, but it's just really kind of playing on the advantages of what we've got, and that's what we deliver. But it's tricky, but that's the way that we see it. ESG is much more stronger.
Okay, good.
For us.
And maybe Christian, just pick up that point around the sustainability side, because I think this is a really big topic both at Expo Real, but also I think across the markets at the moment. So I guess what's happening in terms of the Nordics, looking at that affordability side, looking at sustainability more generally there in terms of the residential side.
If we take in terms of the affordability and we focus on the S side, we are starting to see regulations in some markets. I think Denmark was the front runner with introducing a rental cap of 4% instead of following CPI. And a lot is saying that this is very terrible for landlords. I'm in general not pro of making unchanged or immediate regulation. But on the other side, we also see a CPI basket that is very much driven by utility cost, which the tenants are paying on top of rent. So that we as a landlord should be able to cannibalize on that is not fair either. So we definitely see an increased regulatory pressure across our markets. The E in ESG, which has been the main focus for several years now, both in relation to construction, investing in the existing stock, is of course becoming even more financially viable now, that the saved cost that you have on your utility bill, whether it's through your tenants or whether it's the direct cost of the landlord, is making those investments much more viable. So I definitely believe that this is certainly a drive for driving ESG investments to a new standpoint.
Okay, good, thanks. And also thank you to everybody who's tuning in online via the live stream. If you've got any questions, do feel free to add those. I know there's one already on CMBS, and I'll come to that. And if anybody's got any questions here, just do ask them, and we'll try to deal with them. That is the joy of being live and here in person. Agata, ESG, there's obviously been often when you've been looking at CE markets, has been viewed as being behind the other Western markets. But on the other hand, obviously there's a lot of new stock being developed in terms of the sustainability side. What's the position there? And are you also beginning to see more regulation coming into the market? What are you seeing there?
Well, in particular on the point of ESG, I would a bit disagree, as I also mentioned in the first questions, because most of the stock also on the residential sector, it's simply new, which is developed with the new, although even if there are no really strict regulations, driven also by the increase of energy costs, there is a lot of importance put on having the building more energy resistance, more safe, etc. So, well, although this seems to be that CE is behind, somehow with the developments which are for the institutional investors and for on the resi for rent market, there is really new stock. So I really think that sometimes it's really worth to look into details, yes, from that perspective. And regarding the new regulations coming, I think it's like everywhere, like simply European Union imposing new regulations, and there will be no stop on that. So far this was more on E, currently also the taxonomy came, and this will go further with C and G as well. But I also believe that, again, due to the economic situation which we have currently, this will be not only fulfillment of economic regulations, but also putting more importance on these aspects in order to simply reduce the costs, if possible, yes, as you just mentioned, yes. This will become more and more important. Currently, some stelling, it's really difficult to say, but the energy costs in some places increase, 8 times or 6 times, yes, and you never know how this will go further. So I think that it's the first time when it's not only about regulation, but about the real costs and real money which you need to pay, like everyday bill, yes, and this will drive. On the CE market, we do not see currently any pressure on having the tough regulations like rent increase bans or anything like this. On the other hand, we have some regulations supporting the ownership still, but it's really kind of minimum, yes. So I still believe that the main indicators will influence this market, yes. So according to the Markus chart, this was visible that there is kind of no huge increase in Western countries when it goes to the rental levels. And in the CE, it's just the opposite. When you will look on the trends in Prague or Warsaw or Budapest, you will see just the opposite. There are increase. And in Poland, in Warsaw, well, maybe temporary a bit due to the refugees inflow. In Warsaw, there was even 40% increase. So
in terms of the rental in Warsaw, that's increasing, yes, because of the lack of supply, I guess.
Yes, exactly.
Okay, that's interesting.
And the gap is still really huge on the whole residential market.
Okay, good. Rainer, just coming to you, I want to pick up a little bit on what you're seeing in terms of rents. I think would be interesting, and I guess the supply-demand fundamentals, because there's a lot of focus on what's happening in the economy and with interest rates. But it'd be interesting just to touch on the fundamentals there, and also, I guess, how you see the difference between the sort of micro-living, co-living, student, versus PRS kind of sectors. Do you think one is stronger than the other at the moment? What's your sense of that?
Well, if we allow ourselves for a minute to leave aside still existing supply chain disruptions from COVID, energy supply issues, energy price issues, interest rates, inflation, the underlying fundamentals of all resi segments are still characterized in all European countries by an imbalance between demand and offer. We have urban areas, so-called swarm cities in every European country that have a positive migration. If you take, for example, the city of Hamburg, they have a positive migration of some 50,000 people per year. Over the last 3 years, I think on average, there have been 5,000 to 7,000 units been brought to the market. Just as an illustration, which is the same in Amsterdam, it's the same in Madrid, it's the same wherever you go in Europe. And where does that lead to? That leads to the fact that A, rents are rising, B, those who can afford and are more flexible are looking for potentially smaller units. So we have also a strong shift on the demand side on a different quality than most of the existing stock, and also on different size typologies. And this leads me then to your question on co-living and micro-living. I think in general these markets can be characterized that there is no one type needs to fit all requirements. We see a very heterogeneous development where younger people are looking for accommodation types coming from student accommodation, then having their first job, looking into something similar, trying to maintain their networks, trying to maintain a private life where they are with peers on schemes, where they have community, which makes it easier for them to settle in a new city and things like that. And the next big thing, which is a driver from my point of view, is that the, let's say, generation contract that you have had over decades, young families moving out of the cities, allowing elderly to come back into the city, is no longer existing. What you see for, let's say, some 10 years now as a phenomenon is that younger families are not leaving the cities anymore. They maintain their flat that they have secured over the years. They try to manage to escape from facing higher costs moving somewhere else. And this puts additional pressure on cities and consequently rising rents. And on the end of the next phase, not to call it the end of the spectrum, senior living, we all have demographic challenges all over Europe, which are not appropriately currently factored in what politics are doing, what the industry is doing, and which provides a lot of opportunities as well. So bottom line, on all phases, starting from student, ending up in senior living, there's a huge demand. And as the current parameters as regards interest rates, construction costs have led obviously to a very sharp drop in new developments. It's quite foreseeable that at least for the next 2 to 3 years, way below average number of units in these segments will come to the market, and giving a further push on rents on existing stock.
Okay, good. Mark, it'd be interesting, I think, to get from you, I guess, your perspective on what you're seeing in the market at the moment. I mean, are deals happening? Are people needing to be more creative to get deals through? What's the situation there? And I guess, it'd be interesting also to pick up on that point about regulation, how you see that from Greystar's point of view.
Yeah, sure. Well, actually, Rainier, he stole a lot of thunder already, but I think affordability is one of the key issues in all the markets that we operate in. And I think the Netherlands typically is a market, if I pick just one, where the government typically is very concerned about affordability and thus imposes quite a lot of regulation. So there's actually new regulation been announced last couple of months that will be introduced early next year, which regulates the regulated segment even a bit further. But what you also see happening there is that the Dutch government is also, as we have the famous point system in the Netherlands, is that they will allow significantly more points for residential units that have high energy efficiency labels, and effectively pricing in what other speakers also already said is the fact that you can actually charge higher rents if energy bills are lower, because it's more of a total cost of living picture that you need to look at instead of just the base rent. And that is actually where I think with new developments you are really well positioned, because you can provide the newest product to the market in terms of sustainability and energy consumption. Another interesting point that and I totally agree with what Jake said about modular build, is what we see happening in the Netherlands, but also in other countries like in the UK, in Germany and Austria, is that there is strong urbanization, but also in all of those countries, and I think the Netherlands and the London area are sort of the outliers there. There's a lot of competition for usage of land, not only from residential or commercial buildings, but also from other economic activities, which actually means that out of every square meter of land that you have available, you need to get the best use as you can, which means that you have to live a bit smaller, but also that you need to shift towards modular construction, because it's incredibly difficult in cities like Rotterdam or Amsterdam, in very dense areas, to use traditional construction in order to build your projects in a safe but also in a time efficient way. Coming back to demographic development, so we see across all the countries that we operate in is household formations that are rising in terms of amount of households, but obviously the number of persons per households is dropping. And that is also one of the big affordability challenges that sits there, because affordability is not necessarily a rent issue, it's also an income issue. And what we typically saw in the Netherlands, that in the past, let's say 5 to 10 years, you typically would use two incomes to either serve your mortgage or to pay your rent. Now that you have more one-person households, it essentially means that you have to simply make the homes a bit smaller, which can easily be done by still providing a very good product, as long as you design it really well, and as long as you provide additional amenities that sort of create more than just the private space you live in, but really provide that surrounding environment where you really have a nice community and a sort of an extension to your private space. So I actually think there's still a lot of opportunity for development, but like my neighbor already said, it will take a while before land prices start to get to a point where they become feasible again. I think on the flip side, and that's what we see happening in countries like the Netherlands, is that the potential rent upward that is there for newly designed sustainable product will also allow for new developments still to be able to get started, even if your cap rates and your interest rates are expanding a bit.
Okay, good. And Markus, just coming to you, I suppose in terms of the capital side, are you seeing a drop-off in terms of international investors' interest? Are you seeing more of a domestic market, more an international market? What's your sense of that shift in capital flows?
Well, we always saw the shifting of capital flows in the last years. Yeah. Speaking for Austria, which is a mini market, we suddenly had German bonds buying forward purchases in nowhere land, yeah, where domestic investors didn't even look at, simply because there was no alternative product that had the better shape in other cities in Europe. Yeah. And Austria, for example, proved that it was a very stable market in the last 10 years. In general, I think that real estate is the only asset that you can invest in. So all the private investors that do now join together in multi-family offices take place and are actually a reasonable number in the markets. They do buy all over Europe. It doesn't matter where you send your money to, because what we have seen the last 10 years is that domestic markets become smaller and smaller, and the institutional because the institutional investors go over the borders more and more. What I see and what we see right now is that the private money that is on accounts needs to be invested. And for maybe a short story, when I was on the way to Munich, we got an offer for 2 buildings, trophy buildings that in the last 10 years no private person would have bought, because it's a number of 150, 160 million euros. You had never had any private investor bidding for that. Only big insurance companies, banks, trophy buildings for big institutions. And here now we have the private investors also taking part, and they also do develop by now. They also have their own fee development teams. So what happens now with increasing money costs is that you have a new group on the market that will be able to buy all what has been probably in the last 2 years, bought in the last 2 years, with a big development in pricing idea. I mean, the investors that bought in the last 2 years they did bet on increasing prices in real estate, apartments, in rents. I think with, as you said, 6 times higher costs for energy, there will be no increasing rents in residential. This is not possible. We will have smaller apartments, but rents cannot go up. How? My assistants do worry about how they pay their rent now. So they downsize. So new developments, but money will also or will always go to the residential sector, and it will always be people saving and securing their money in the residential sector. It's just a different investor type that is rising again, and that is, we see strongly all the bids we got in the last 3-4 months are basically private funds, multi-family offices, between 10 and 30 million euros purchase prices. That's their field now. Before it was 5 to 10. So this we have now as the new reality, and nothing will change, because real estate is the only possible asset class that you can invest your money into when you want to stay rich. Maybe you don't become as quick rich as it was in the last years, but you stay rich, and the demand is here.
Okay, good. Let's do a quick, because I'm aware that we've only got around 5 minutes left. So let's do a quick sort of view on opportunities. Just in a couple of seconds, just say where you think the main opportunities are, and then I'll check with everybody else as well.
I think everybody who has earned well money in the last years and is able to invest will be buying the maybe too expensive bought properties in the last years, and the investors that have been rising in the last 2 years, unlucky, I guess, because this probably won't be seen in any Excel chart what they planned. So the people with money will buy what is on the market, because the renters and the buyers for flats will always be available. Just a question of money, I think.
Okay, good. And Mark, I suppose it'd be interesting just to pick up that point around the types of buyers that there are in the market, whether that's now more full equity, and also where you're seeing the opportunities.
Yeah, I think let's say I only look at the market from a new build perspective. So we typically do developments. There it is still possible to add some leverage to your investment. I think there are still a lot of investors out there that are seeking for those opportunities, but you have to find the right deals. And I think it will take a while before land values start to come down a bit. in order to get those projects feasible again.
Okay, good. And where do you see in terms of your strategy, where are you looking in terms of the opportunities?
Yeah, it's typically the larger cities in the geographies that we're active in. Not necessarily inner cities. It's more like locations where we can create project of scale, as well as with good public transportation connections. Because we really think that the car is going to sort of be phased out in terms of mobility. So that is exactly the kind of locations that we like.
Okay, perfect. Rainer, over to you. Where do you see the opportunities at the moment in the market?
Well, I think available capital is not the bottleneck. Banks are a little bit shy at the moment, but they're still financing. Yeah. And I think all in all stakeholders need to adjust their metrics for underwritings on new terms going forward. And that I think will take some time. And personally, I would not be surprised if over winter some of the land bankers would see some pressures from their mezzanine providers. And this could be a beginning of a movement of land prices going into a direction that makes transactions then possible and happening earlier next year.
Okay, good. Agata.
So I think that on the CE market, what really can happen, and this can be an opportunity, is that the main land bank holders are big developers who are currently who are developing for sale, and taking into account the current economic situations. In a couple of months, they may be much more encouraged to sell to institutional investors or to change their projects for the resi for rent projects rather than resi for sale, which required adjustment, of course. It's not easy. You need to, from developer's perspective, to reduce your profit, which you assumed to have from that. But I think that this is the opportunity for institutional capital to observe on CE market.
Great. Christian.
I believe that the owners of standing assets will be very slow to accommodate pricing. So I think that there will be a big bid-ask spread between buyers and sellers for the coming quarters. So I'm actually inclined to say that developments where you see landowners becoming a bit more impacted by the rise in interest rates, we also see that contractors are getting more and more pipeline or open capacity from the midst of 2023. We definitely believe a significant slowdown in the construction activity will come. So I think that developments it will be a much better negotiation power from a buyer perspective in the coming year than it was the past year against developers.
Okay, great.
Yeah, I mean, from our perspective as a constructor, I think that the opportunity for us right now is to take a breath. As we know, it's all about timing. So we've got to use, I think, the next quarter to sort of sit down and pull in some more strategic alliances with people like Heimstaden, with Greystar, with other big pipeline suppliers, where we can actually utilize, what we've got, our know-how and our technology, and what we've been sort of practicing for the last 12 months, and to sort of hit the ground, I think, running, I would say Q3 next year. I keep hearing that this is a good target to aim for. It's not too close. It's not too far. It gives people the summer to kind of relax, but then come back. I think Q3 is where we're going to see there's going to be a lot. We're in a stage of finding those opportunities as the market slows down, and as it's been pointed out, land prices and everything is going to sort of start to slide a little bit, and there's going to be more opportunities on the market. But then for us, strategic alliances, maybe with municipalities, maybe where there is a big housing shortage. In these main sort of cluster cities, for us that's the advantage of where we see this situation right now. Take stock, make some strategic moves, behind closed doors, and then hit the ground running in Q3 and be able to deliver, at a pace, good quality, affordable stock. That's what we're doing right now.
Great, really interesting, and I think that crossover as well with partnerships with the cities is going to be a really important part of delivering that sort of affordability side. Thanks very much for joining us. Thank you very much for joining us online as well. Really interesting discussion. look forward to picking up, and I'll take that Q3 comment into the other sessions and see whether everybody agrees with that as well. Just in terms of the sessions on day one, you can see we've got sustainable logistics coming up, then investing in cities, Germany, we've also got debt, the Netherlands, social impact, affordable housing, logistics, global trends, and then networking drinks. So do feel free to join us for all or any of those. And thank you very much. Thank you to the panel, and thank you all for joining us. Thank you, everybody.